And today we want to talk about the investors and what they should do at the end of the financial year. And we should actually say, when it comes to, say, things that you might do for tax reasons, be careful. We never ever think it's a great idea to invest purely for taxation purposes. Paul?
Well, yeah, absolutely. Let's start at the beginning. And of course, the basic strategy, Peter, is to maximise expenses and potentially defer revenue.
Yep.
Your cash flow's got to be strong to do this, and you've got to have a taxable income. But let's look at some of the strategies. So if you can prepay interest on a loan. Could be a margin loan, could be something else, but potentially up to 13 months, get the tax deduction in this financial year rather than the next financial year.
Yep.
If you accelerate the payment of any other expenses, for example, might be a subscription to an investment newsletter, see if you can do that this tax year. Make donations to charities. And of course, if you're an SME, take advantage of the instant asset write-off, and that allows businesses of turnover of up to $50 million. That's pretty well, most businesses. To purchase an asset of up to $30,000, excluding GST, and get a tax write-off 100% this tax year.
And it's not just one. You can do as many as you like.
You can do as many as you like. So that's a pretty big boon. Of course, the only caveat on that, you've got to have the cash flow and you've got to have a taxable income. But
exactly.
If you're running a business and you need some equipment, don't forget to think about the instant asset write-off between now and the 30th of June. Finally, look, if you're a business or a contractor, you may be able to defer revenue to the following tax year. So invoice your clients in the start of next tax year rather than this tax year. That just gives you potentially a deferral revenue.
Okay. What about managing capital gains tax, Paul?
Yeah, just to recap, because this is important for investors, particularly capital gains tax, which is payable on the disposal of an asset. That's a sale, but it can be things like takeovers and other things. It actually triggers a disposal. Applies pretty well to every asset, Peter. Shares, land, property. The main exemption, of course, is the family home. The gain is added to your taxable income and assessed at your marginal tax rate. There are discounts available to some investors, so individual investors who've owned an asset for more than 12 months are eligible for a 50% discount. Super funds get a third discount. And of course, if you've got capital losses, they can be offset against capital gains. You can't apply losses against other taxable income, but you can apply a capital loss against a capital gain.
Okay, so the strategies for actually managing capital gains are really
well,
important.
the first one is about the 12 months and the discount eligibility.
Yep.
So if you've got an asset you think you're selling, you've owned it for 11 months and 30 days, I'd say wait.
Yeah, most definitely.
Wait at least till 12 months and get the 50% discount. So just think about how long you've owned an asset to see whether you're actually eligible for the discount. Obviously, if you can, and you are liable to pay capital gains tax, you might want to reduce those with any capital losses, so you can offset gains with losses. Importantly, Peter, you can actually, if you're a share investor, you can choose which parcel of shares to maximise the loss or gain. There's no fixed rule about this, so you can apply a FIFO, that's first in, first out, or a LIFO, last in, first out. There's actually no fixed method of apportionment here, so it's up to you as the taxpayer to choose which method you want to do. And you can do that to actually sort of optimise your position. If you have made capital losses, don't forget about them. You can carry them forward for one tax year to the next. So again, you might have losses from last year that you haven't utilised. Just double check on those.
Yep.
You can't do wash trades, but you can, of course, manage your tax position. And so when we say manage your tax position, if you've taken gains through the year, you might like to look through your portfolio and say, have I got stocks in a loss situation that I really don't want? And is it now time to flick those out? And vice versa.
But Paul, you've got to be careful. Sometimes people sell their stocks to crystallise a loss, but they then miss out on the dividends. So they've got to be careful about that as well.
That's right. You've got to make sure you actually want to, if there's no point selling a stock if you really want to own it. So it's important to think about this, first of all, from an investment point of view first, and then a tax point of view. But sometimes the 30th of June is just a bit of a wake-up call, because there's generally, in most portfolios, a couple of dogs we probably should have got rid of.
Very unfair on dogs, Paul. Super concessions, let's talk about those.
Look, finally, super concessions are important. The super year, of course, works on a financial year basis, so there are things that you need to do before 30th of June, or at least look at whether you can do.
Yep.
So first of all, look at the way the government is actually helping people to build their superannuation nest egg. Things like the spouse tax offset. So that's where you make a contribution for your spouse. You help him or her with their super by making up to a $3,000 contribution. And if they earn less than $37,000, you get a tax rebate of $540. So give your spouse, boost your spouse's super, you get the tax benefit. That sounds like a pretty good deal for a relationship. There's also the government co-contribution. This has been around for many years, but potentially if a low-income worker, if $1,000 goes into super, the government puts an additional $500. Look, 3 tests, they've got to be under 71, income less than 37,697. There's a phase out there as well. And 10% of that income's got to come from employment sources. So they can't just be a stay-at-home person. They've actually got to have some employment income, and that's probably the most important test. Could work for a low-income spouse. Could work, for example, if you've got adult kids and they're doing a bit of part-time work and you want to help them with their super,
point.
You might make the contribution and they get the co-contribution from government. So don't forget about that. There aren't too many free handouts from government.
That's true.
Finally, you might be able to make tax-deductible contributions. So remember, there's a $25,000 cap that applies to concessional contributions. There are 3 parts of that. That's the employer's 9.5%, the compulsory part. It's any amount you've salary sacrificed. And the third component is any additional contribution you're able to make. That is actually tax-deductible. It used to apply just to the self-employed. So it was always self-employed were treated fairly in the system. It now applies to everybody. So if you've got under your $25,000 cap and you're paying tax, or you've got a spouse in that situation who's also paying tax, you may want to get a contribution which they make, and they can then get a tax.
And it helps those employees whose bosses don't do salary sacrifice.
Yeah, not all employers offer salary sacrifice, Peter. So again, the timings are the essence here. 30th of June, or it's got to be in the super fund by the 28th of June. That's a Friday. If it's a public fund or a retail fund, they generally need a couple of days to get the money in. So you don't have long to act on some of these concessions.
Okay.